Logic dictates that given their extremely high level of technical development...
Well, it's too technical to explain to the lay mind.
Well, we are talking technicals, and we hope it is not too technical at all. And in fact, we've got someone new, because I know you like hearing from new experts. Well, my guest today is Don Vandenbord. He is Chief Investment Officer at Revere Asset Management. And if you go to revereasset.com, well, they post nightly market videos, which include his portfolio changes, so you can see real time what he is thinking and talking about. By the way, if you don't want to go to the website, but you happen to be active on YouTube, search Revere Asset on YouTube, and you will find the videos there. Don Vandenbord, welcome to Money Life.
Great to be with you, Chuck.
So I love talking technicals with folks, and as you heard in the intro, we always worry it's a little too technical for the lay mind. But just a little bit, because it's very clear to me you've got a very specific technical take. So before I jump in and say, hey, what do you see happening now? Tell us what is important to you and how you use technicals, and then we'll get into what you're seeing with the technicals you use.
Sure. Basically, we are kind of disciples of the William O'Neill approach to the market, which is determine what the overall market trend is, and then look for the best stocks in the leading sectors when the market is in an uptrend. This is the best way to quote unquote time the market. I know that's a dirty word to some people in the industry, but the alternative is to just sit there and maybe take the downside when you don't necessarily have to. I like to liken it to, you check the weather before you go out for the day. If it's going to rain, you take an umbrella with you. The market puts off similar signals for your portfolio, whether the sun is shining or it's cloudy or if it's a downpour. And we take a look at the technicals on 3 time frames, short term, medium term, and long term, and then identify the best stocks and the best sectors when the market is in our favor.
Well, so let's talk about the trends you're seeing now, because this has been a market that has had plenty of chop. And really the trends that most people have been looking for, at least throughout this year, have been the Magnificent Seven or what have you. You haven't seen much outside of that that's been moving. So is this a market that has strong enough trends? And if so, what are the trends you're seeing?
The trends are constantly changing is what we've seen. You mentioned that the Big Seven, the Magnificent Seven, have led this year. They're actually showing some relative weakness over the last week, and market breadth has been expanding and other sectors are coming to the fore. And that's a good backdrop for the market, a good spot for us to start researching and getting into some new names. We saw the big cap indexes lead, stay above their 200-day, their 50-day, their 21-day moving average since 11/1, when the last FOMC meeting was greeted as dovish by the market. And then on 11/14 was another inflection point. We had a big gap up on CPI. And overall, that really changed. That was 2 occurrences that happened that really changed the tone of the market. It ended the 3 waves down correction that we were in off of the July highs and got us back to where we were pretty interested in being invested in the market again.
So where are you investing if you're interested in being in the market again?
Well, every night on the videos, we post kind of a stop sign or a stop, go, neutral indication for the 3 time frames. The short-term time frame we use is the 21-day exponential moving average. The medium term is the 50-day moving average. The long term is the 200-day moving average. It's important, and this is why we're a combination of an active and a passive asset manager. It's important to take extreme caution when you're under the 200-day moving average. This is when people's nest egg can get devastated if they're entering into getting close to retirement and we go into a severe bear market. There have been 13 of them since back in 1970. The most severe, the S&P 500 dropped over 50%. You do not want to get caught in that situation. So if you just use the 200-day moving average as a long-term indicator to kind of pull the ripcord, that will allow you to sleep at night. And then we use various short-term indicators to determine how invested we're going to be in the market. But then ultimately, we monitor the 5 major indexes. That's the Dow, the S&P, the NASDAQ 100, the S&P 400 mid-cap, and the Russell 2000. Where are they relative to their moving averages? And then what sectors within those are acting the best? So we have been focused on tech over the last couple of weeks, really for the month of November, as those are the stocks that really started to stand out, particularly security software. The Big 7 stocks had a decent run. But now, as I said, they've shown a little bit of relative weakness over the last week, but we're broadening out. You're seeing financials doing well right now. Today, for instance, it's right after noon on Thursday. The big seven, nine are all red on the day. The three tech sectors, XLC, XLK, XLY, are red, and oils are red, but all the other 7 sectors out of the 11 spider sectors are green. So we're seeing a rotation take place, and ultimately that increased breadth is good for the market. So we're looking for individual opportunities, and we definitely want to see the indexes stay above their 21-day exponential moving average. That's when we put the so-called pedal to the metal in our really kick up our percentage invested.
If we try to explain this out, you guys have what you call your GROTECTION gauge, and your GROTECTION gauge kind of puts it all together. And basically, everything looks good to you right now, except the long term is fairly neutral. So when you've got that kind of situation, I mean, there are people who are looking to buy very short term. For you, if the long term is neutral, is the long term's next move the one that's going to determine what you do in terms of really where you're going?
No, we'll focus on what's working and just avoid what's not. The reason we're on neutral is because small caps have not been able to recapture their 200-day moving average. They're battling that level right now, and that's really good because it'll increase the breadth of the market if we can get small caps participating. They've really been the standout laggard year to date. And as far as, you said GROTECTION, that's our flagship portfolio. It's a combination of the words growth and protection. We grow assets when the market winds are at or we have tailwinds, and we protect assets when we're going sideways or like we were in 2022 when we had a bear market. And especially when the indices are under the 200-day moving average, that's when we pretty much get out of the way.
So given the run that the market has been on of late, is there a level of resistance that you are looking at? And is there a level of support that you feel if we hit it, we might be going down to?
We don't make predictions. We interpret and have expectations based on what the overall market's doing. And again, it's tied to the short-term moving average, the 21-day. We place a lot of emphasis on that. And all 5 of the indexes are above that and their 50-day moving average. So that kind of gives us the green light to really seek out the best of the best stocks in the best sectors. And right now, what has happened with those 2 strong moves up that we had, first the one that started on 11/1 and then of 11/14, we've gone a little bit too far too fast. Sentiment has really gone from being bearish or being too bearish to being too bullish now. In fact, the AAII survey that just came out now, bears are under 20%, which is sentiment is a pretty good indicator when it's at extremes. And we're backing off the gas a little bit because of how extended we are, and also seeing some money coming out of those big cap indexes, those big 7 stocks. That's going to weigh on the S&P 500 and it's going to weigh on the NASDAQ 100. But on the good side, it's going to allow for better opportunities to go into smaller, large cap and mid cap growth stocks. And those are really what we're kind of focused on right now.
Don, really great stuff. Thank you so much for joining me on the show. I hope you come back and chat with us again down the line.
Looking forward to it, Chuck. Thank you very much.
That's Don Vandenbord. He is Chief Investment Officer at Revere Asset Management. It is revereasset.com. Again, go looking for their nightly moves. You can find them there or on their YouTube channel. And Don is on Twitter or X at D Vandenbord. It, of course, is all linked up at the Money Life Show recent and upcoming guest page. Up next, market call time. Yep, Brian Bollinger from Simply Safe Dividends is here in just a moment.